Sold any equity shares recently? Well, if you're advising clients, managing a portfolio, or honestly, just trying to figure out your own returns, you're probably staring at the new capital gains regime and asking yourself one big question. What is the actual tax rate now? Is it 10%, 12.5%, 15%, or wait, is it 20%? It feels a little like a moving target, right? But the answer actually hinges on a few specific new legal provisions and one absolute game changer of a date.
Welcome to today's Explainer. We're diving deep into Chapter 13B of the brand new Income Tax Act 2025. We'll be focusing squarely on the special provisions for capital gains under Sections 196 to 198. Whether you're a CA student, a seasoned tax professional, or a business owner, we are going to break down this entire legal transition into clear, completely actionable takeaways.
Here's our quick roadmap for today. We'll start with an introduction to the special provisions, move on to short-term gains, then long-term gains, walk through a practical taxation example, cover compliance issues, and wrap up with our key takeaways. Let's get to it.
All right, Section 1, Introduction to Special Provisions.
Okay, so for literally decades, we all wrestled with the somewhat fragmented structure of the old 1961 Act. But the new 2025 Act brings some much-needed clarity. Now, if you're a practitioner, you kind of need to rewire your brain and anchor your existing knowledge to this new framework. That famous Section 111A for short-term capital gains on equities, it's reborn as Section 196. Section 112 for other long-term assets is now Section 197. And the widely debated Section 112A for long-term capital gains on equities, that is now explicitly defined right under Section 198. Make sense?
Moving right along to Section 2. Short-term capital gains under Section 196. So, Section 196 kicks in when you sell equity shares, equity-oriented funds, or business trust units, provided securities transaction tax or STT was actually paid. Now, here's where it gets interesting. The new law introduces a strict chronological dividing line for these assets. If your transfer took place before the 23rd of July 2024, your tax rate sits at 15%. But if the transfer happens on or after the 23rd of July 2024, that rate jumps to 20%. It's a massive mid-year shift that every single accountant needs to red flag.
Next up, Section 3, Long-term capital gains under Sections 197 and 198.
Just like we saw with short-term gains, Section 198 dictates a rate transition that pivots entirely on that exact same cutoff date for STT-paid equities. If the transfer happened before July 23, 2024, you're looking at a 10% rate. But the moment that transfer crosses into July 23 or beyond, the rate increases to 12.5%.
But hey, hold on a second. Before you go calculating that 12.5% tax, there is a very important number you must factor in first, 1,25,000 rupees. You see, Section 190A retains a really crucial benefit. It states that these tax rates are only calculated on the long-term gains that actually exceed 1,25,000 rupees in a given tax year. So the first 1,25,000 rupees remains entirely tax-free. A nice little breather, right?
All right, Section 4. Let's look at a practical taxation example to see how this works in the real world.
Let's plot an asset's journey to visually anchor these rules. Imagine your purchase listed equity shares in January 2023. You hold on to them, sailing right past our critical cutoff date of 23 July 2024. Finally, you decide to sell these shares in September 2026. Okay, so what happens? First, because you held the shares for well over 12 months, this is classified as a long-term capital gain under Section 198. Second, because the actual date of sale, September 2026, falls on or after the 23rd of July 2024, any gains exceeding your 125,000 rupees exemption limit will be taxed at the new rate of 12.5%.
Now, here's a really nice simplification highlighted in the transition guidance notes. Under the old 1961 Act, we constantly juggled the previous year and the assessment year, right? Well, the 2025 Act merges these. The year you earn the income and the year it is assessed now share a single term. So that sale in September 2026, it simply falls strictly under tax year 2026-27. So much cleaner.
Section 5, Compliance and Common Issues. Look, mastering the theory is only half the battle. According to the transition FAQs, you need strict compliance to avoid common pitfalls. First, meticulously maintain your STT payment documentation. Second, accurately reconcile your Form 26AS, making absolutely sure you separate old Act years from new Act years. And practically speaking, file early. Transitioning to the new tax year system is bound to create some portal glitches, so giving yourself buffer time is going to be your best friend.
Now, another huge area of concern is how to handle brought forward capital losses. People ask about this all the time. Here is the clarity you need. Under the transitional provisions of Section 536 of the new Act, yes, you can carry forward and set off losses from earlier years. However, and this is a big however, this is only allowed if those losses were legally eligible to be carried forward under the old 1961 Act. The repeal does not magically revive ineligible claims. Furthermore, there is a strict bar under Section 120 of the 2025 Act, which actually mirrors the old Section 79A, expressly prohibiting taxpayers from setting off any brought forward losses against undisclosed income discovered during a search or survey. So no loopholes there.
Almost done. Section 6, Summary and Key Takeaways.
Let's lock the 5 key takeaways into memory. Number 1. Section 196 now governs short-term capital gains, and Section 198 governs long-term capital gains for equities. Number 2. The absolute pivotal date for determining your tax rate is the 23rd of July 2024. Number 3. For transfers on or after that date, STCG rates increased from 15% to 20%. Number 4. For LTCG, the rates shifted from 10% to 12.5% post-cutoff. And number 5, that highly beneficial 1,25,000 rupees exemption limit for long-term capital gains on equities remains fully intact.
Thank you so much for watching this explainer. Please like, subscribe, and share. And as we fully step into this new era of the 2025 Act, the rules of the game have officially changed. So how will you adapt your tax planning strategies today to protect your clients tomorrow? Think about it.
This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.